Hi, Dan. This is Mark. So you're going to be sitting on quite a bit of cash in a very strong US dollar environment. So you've got a great currency behind you. You've got some money to deploy. Are you tempted by some of the other sectors around the world? Does Asia look cheap to you, or some parts of Europe? Is there anywhere you're thinking of deploying your cash outside the United States?
Yeah, I mean, we actually took some positions in emerging markets because we think all the rhetoric and all the fear around Donald Trump and tariffs, it's funny when you hear people just sort of take him at his word at, oh my God, he's going to put 60% tariffs on China or whatever, and then they panic. And then you figure out, well, he's a businessman. And you've already had 4 years of this, where that's a starting point in negotiation, and where you ultimately end up is typically a lot better than that. So to your point, Mark, if you look at the relative valuations around the globe, yes, on a going forward basis for 12 months, the S&P is sitting at about 22 times or so. But if you look at some of these other markets, you've got the Nikkei sitting at about 19 times. You've got the Indian stock market sitting about 20 times, but the China stock market is sitting about 13 times. So a lot of these other markets have underperformed for the last 2-3 years. They're very cheap for obvious reasons. People are afraid of tariffs coming out of President Trump. But I think to some degree, and you saw that with some of the moves since the beginning of the year, is maybe they're a little bit overdone. And so that's where I'm looking, because the valuations, to your point, as you brought up, are a lot more compelling there. And then also in the US, the markets have really been driven by 7 stocks, the Magnificent Seven. And I think there's going to be an AI digestion phase. And we've been writing about this now for several months. And you're seeing signs of it from some of what Microsoft has said over the past month, which we can get into. But if that trade starts to fall apart, and given you've got 7 stocks that are somewhat tied to the AI trade that are driving the US market, that are 35%, let's say, of the S&P 500, and are trading at valuations in the low 30 times range, then you've got a huge problem potentially. And that money could also flow into these foreign markets that are a lot more hated, where the valuations are cheaper.
Dan, we'll pick up on AI and chips slightly later. Just to pick up on what you talked about, deploying your assets in markets, in Asia, emerging markets included. You talked about that low valuation in China. And as you said, it's low for a reason. Is it compelling enough for you right now to be pumping money into that market?
Yeah, I mean, we own some stocks in there, but the thing with China, which makes it difficult, is 2 things. They've talked about in the past where handing out checks directly to consumers, they view it as a form of welfarism, rightly or wrongly. And they don't want people to get addicted to that. So you don't get this overstimulation that you've seen in markets like the US in particular, where they were handing out checks for people unemployed, or in Europe. And so you don't have that big bazooka effect, for lack of a better term, that will drive valuations and markets up on euphoria. And so any kind of recovery is likely to be a lot more measured. The second big problem, quite honestly, is the same one Japan suffered through for decades, which is there's only 2 real ways to grow the real economy, right? There's population growth, and then the productivity increases on that population growth. Well, in China, for the first time in 60 years, the population went down, and based on the demographic trends, they're probably going to go down for the next decade at least. And so much like Japan had to suffer through that, unless you get a massive increase in productivity, which, given some of the restrictions on technology coming out of the US, it's hard to believe, those are some of the things you're going to have to struggle with. So for us, we picked cash as our top pick, but we have 4 other names. 2 of them, Cisco and Adtran, are sitting in the telecom services space. We like the mid-cap stocks today. One of our other top picks, which is KBWB, which is the bank ETF in the US, that benefits from deregulation and tax cuts. So there are other names that we like in the US. We're just saying that it could be a very volatile year, and don't be surprised And that's why we don't have a Magnificent Seven in that group of five, which we've always had one or two stocks in there. Last year, for example, we had both Meta and Amazon in our top five picks. We don't have one of those names in there this year because we do think there's some real AI digestion risk and there's better places to deploy. And all of those names I mentioned, mid-cap value, the bank ETF, Adtran, Cisco, those other four names, they all have very compelling valuations relative to their peers or the market.
You like mid-caps. Why not small caps? They also have compelling valuations.
Well, it's a great question, Haslinda. The big reason's the following. If you think about what I'm worried about, which is the Fed having to raise rates potentially as you get towards the end of this year, small caps struggle in that environment because they just happen to be smaller. And so a rate environment that's more beneficial to them really helps them out a lot more. And also, if the economy is slowing down, they don't have as much revenues to cover the fixed costs. If you look at the mid-cap space, by definition, they're mid-cap, right? So they're a little bit bigger. They can handle a tougher operating environment. But that's also why we say it's mid-cap value, not mid-cap, because mid-cap growth has also benefited from the same trends that have driven the overall market. And that's why we're saying mid-cap value is more interesting, because the S&P 500 over the last 5 years, if you think about it, first, it was a couple of years of investment during COVID because everybody's going online. So you have all this internet infrastructure spending happening. Then for the last 2 years, it's all been about AI. And so the S&P 500 over the last 5 years is up 82%. The mid-cap value space has underperformed that by 35% over that period of time and trades at a 17 multiple, not the 25 times trailing multiple that the S&P 500 is trading at. So, and you've seen this during 2022 when the Fed was hiking really fast, and quite honestly, during 01, 02, when you had the tech bubble break, which if it gets really bad in AI, I don't think it'll be that bad, but it could happen. That also held up very, very well. And so in a tougher environment, they also hold up nicely. And things like tax cuts and deregulation help the mid-cap names more than they're going to help the S&P 500 names, where they've already got low borrowing costs. They're huge. They don't care as much about that.
All right, Dan, it's Mark again. You were talking about the potential risk of an interest rate hike in the States. Well, we've got one very much on the radar here in Asia. There's a lot of talk that the Bank of Japan could be raising interest rates next week, of course, from very, very low levels. Now, that may well give some support to the Japanese yen. Do you think that will work out in some way as a positive? People will be more attracted to Japanese markets because of a stronger currency, or is that going to be something which breaks the sentiment? There'll be a lot of money rushing into Japan over the past couple of years. Is it good or bad if they have an interest rate hike next week?
Mark, you framed that beautifully. I mean, I always say it's never the data, it's the market's reaction to the data, right? Because if I tell you, hey, inflation's going to go up 6% over a year, you may go, oh my God, that's terrible for markets. Except if it's 2021, in which case the S&P went up 27%, right? So I think it'll actually be good for Japan because the reason they're having to raise rates is maybe faster growth, some inflation. People really hate deflation, and Japan's been struggling with that for decades. And so I think in Japan's case, with the support, as you rightly pointed out, for the currency, if I were to bet, I think it's going to be more supportive for their economy versus negative. And so that's kind of how I would think about it as it relates to Japan specifically. The valuations, because the market has rallied so much from the lows, it's not hugely compelling at 19 times versus the China market sitting closer to 13 times, but it is lower than the S&P at 22. And obviously a lot, the AI companies for the most part are all sitting in the US. And so foreign markets by definition have struggled because of that. And the dollar, as you pointed out, relative to the yen, the dollar by itself has gone up from 101 at the end of Q3 to about 109 at the end of Q4. And so that's put tremendous pressure on anything that isn't US based, right, for that reason. And so we'll see what happens going forward. But I think the way you framed it was perfect.
Right.
And I tend to be more on the bullish side on it.
You know, Dan, this is a theme in the tech space, isn't it? I mean, that's what we're seeing with the Max 7 as well. They just keep bidding up the valuations.
Yeah, absolutely. And quite honestly, for the last couple of years, that's been the right thing to do because the AI trend has been so strong. But I think what investors should be concerned about is if you look at the biggest spender by far on AI CapEx, it's Microsoft. And part of that is obviously Microsoft has a 49% economic interest in OpenAI, which started this whole AI theme, which with their introduction of ChatGPT at the end of 2022. And Microsoft's CapEx has been growing at 70 to 80% year over year for the last 6 quarters, if you include December. But on January 3rd, they came out in a blog post and said, we're going to spend $80 billion on CapEx in their next fiscal year, which ends in June. But if you go and do the math, they already spent $20 billion in September quarter. They guided that up for the December quarter. And so you go, well, wait a minute, that means there's more than $40 billion in the first 6 months of fiscal 25, which means they're going to spend less than that in the next 6 months after growing 70 to 80% year over year for the last 6 quarters. So if you're any kind of chip company that sells into Microsoft or any of these other big hyperscalers, I think you're going to see a dramatic slowdown in revenues by the time you get to the middle of the year. And by the way, that's what you saw after all that investment during COVID. Because don't forget, Nvidia, which is the poster child for this trade, their revenues before COVID were negative year over year for about 3 quarters. And then COVID hit, and then the revenues surged to being up over 80% year over year by the beginning of 2021, because we're all locked up, right? We're all going online. Then once we all get unlocked, those revenues went from up over 80% year over year to down over 20% year over year. The stock got crushed, went down over 60% during that move from peak to trough. And then you got the AI trade, and you're back up to these levels, but I think you're going to see another slowdown after growing for 2 years over 100% year over year in revenues.
Dan, Nvidia is not in your top 5, but that doesn't mean you can't still make money with Nvidia. A lot of the guests that we've had on the show say that it is a must in your portfolio. We know that it's risen 800% over the last 2 years. There's still money to be had, right? Even if it's not going to be at the pace that we've been seeing in the last 2 years.
As I said, the last time you had to go through a digestion phase after COVID, Nvidia's stock went down over 60%, 60 from peak to trough. Right now, forecasts are for Nvidia's revenues to grow over 50% this year. I don't think it's going to be even close, because if you think about it this way, if your biggest customer is Microsoft, and it's growing, and it's going from growing their CapEx 70 to 80% to basically 0 in 6 months, you've got to think through that, because all of these big hyperscalers, they kind of move together to some degree. And so if Amazon and Google, et cetera, see Microsoft spending slowing down that much, and by the way, it's slowing down for a good reason, because you're spending all this money, but the question is, have you seen any return on that investment? So if you think about Microsoft in particular, especially given their relationship with OpenAI, when they reported the June quarter, they guided revenues below consensus for September, despite CapEx expectations going up. Then when they reported the September quarter, they guided revenues below expectations for December, despite CapEx expectations going up. So at a certain point, if you're not seeing the return, you're going to slow down that spending. And by the way, that goes for the other big guys as well, which is why I think you're going to see CapEx slow for the industry as a whole from growing 50 to 60% down into a 10 to 20% range. And I think Nvidia, I would be very careful on that stock this year. Now, it doesn't mean over the next, 3 years, 2 years, you can't see still growth. But I don't think anybody wants to go through a 60% loss like they saw after the COVID hangover. And you could see some very big downward revisions, especially when forecasts are for 50% growth for Nvidia's revenues in calendar 25. So That's why I think you have to be very careful of all of the AI related stocks, because if Nvidia gets hit and there's an issue, everything's going to go down.